So if you look at a balanced portfolio, 60-40 in the US or in Australia, it's unlikely to return you a real return over the next 10 years. That's how bad and how bad yields are and how richly priced assets are right now. And that's a function of quantitative easing. Mervyn King, the then governor of the Bank of England, talked about it as bringing forward future asset class returns to today. Well, they've done that in spades. And what they've done is they've compressed volatility. So central banks want to hike rates. The Fed has got a meeting tonight. They're probably going to come out hawkish. And they've told you explicitly they want to do 1 more interest rate hike this year and 3 next year. So that's 100 basis points on rates. But the market doesn't even think they'll do 2 rate hikes by the end of next year. So why is that? Why is there this disconnect between what the Fed's telling you and what the market expects? And it's due to this. It's disinflation. We can see here on the left-hand chart how important the oil price has been to the inflation rates. So since mid-2014, the oil price has driven up headline inflation rates across the world, and I'll just use Europe here. But since we've seen late 15, early 16, we've seen a 50% fall in the oil price, and that's what's pressuring inflation rates down now. That's why we're seeing disinflation. But it's not only the oil price. If you look at the charts on the right, you can see that everywhere in the world is suffering from this disinflation. And that's due to technology disruption. It's due to changing working practices across the world as we move from full-time to part-time workers. And it's due to lower productivity and lower capex. And all of this under the umbrella of much higher debt. And total world debt now is higher than it was pre-GFC. So what central banks have been trying to do is to goose GDP growth up by forcing you to take more debt, but it reaches its ultimate limit when the world doesn't want any more debt and it's unable to sustain it. So if the central banks do want to increase their interest rates, or they want to, in the case of BOJ and the ECB, reduce the size of their monetary easing, what does that mean? Well, we know, and you saw it from the first chart, that when they pumped huge amounts of money into the system, it dampened volatility. So by definition, if they're taking money out of the system, it has to increase vol. We could see from this chart, which shows you the Chinese credit impulse relative to the VIX, there's a good reason for the VIX to start picking up now. Now I can show you 20 or 30 other charts, all of them showing you that equity volatility is super cheap. And you can see that because it's at 9.5 on the VIX, the lowest it's been since 1993. And I showed you on that earlier chart that the 6-month moving average is the lowest it's pretty much ever been in history. So we know vol is cheap, but I would argue that we're at a point where vol should start picking up now.